Today, folks, we're going to dive into the two most prolific dividend stocks in the investing community. And don't take my word for it, because the likes of PPC Ian, one of these OG investors I followed on YouTube for a very long time, he has put Starbucks and McDonald's at the top of his investing list. Again, not as financial advice, but these two prolific dividend stocks operate in very intriguing manners compared to most dividend companies and comparable to REITs or infrastructure-oriented companies. And if this is a conversation you'd appreciate, damn it, go hit that like button on your path to financial independence. Perhaps one day retire early like I am. And if you want to join that journey, consider hitting subscribe. Now, PPC Ian's favorite is Starbucks, and I want to do a side-by-side comparable and what one I'm actually more favored toward. Taking a look at Starbucks here has been on an absolute tear since 2014. I mean, the stock's up 120%. At its peak, it was up about 223%. I know the dividend yield is a bit lower, but these things are fabulous for dividend growth and stability. Yet Starbucks has kind of seen a lot more volatility over the last 5 years thanks to unionization. I mean, there's been a lot going on since the pandemic that's led to a lot of volatility as of recently as well. You know, for almost $100 billion market cap, let's just kind of get into this, because many of you know Starbucks is a bougie damn place. And for a guy that doesn't want to spend money on any, I mean, I got my Nestle instant coffee. I mean, this coffee probably cost me like 10 cents to make, right? Like, I am not a guy that is ever going to really walk into a Starbucks. I like bubble tea. There's some specialty drinks that I'll buy. But when you take a look at a $5 to $8 coffee, I mean, as somebody that compares compound interest against all his living expenses, knowing that over a 30, 40-year period, that $5 could easily turn into 40 to 80 bucks. Yeah, I'm not really going to be going to Starbucks every day. I just can't be one of those bougie people on their way to work. More McDonald's guy, and we'll talk about McDonald's in a minute. But, you know, we're talking about a stock that was paying out a 13-cent dividend 10 years ago, and as of recently is paying out 57 cents, which is damn near a 3-4xing of the dividend over a decade. Though over the last 5 years, the dividend growth rate has been slowing down from 36 cents to about 57 cents. We're still on path to see it doubling. If you take a look at the dividend scorecard, I mean, we're getting about a 9.78% 5-year growth rate. That GIGR is really, really healthy, to say the least. But let's talk about the numbers, because some of my biggest concerns with Starbucks, for a company that charges so much for coffee, I'd have to do a bit of digging to figure out why their net margins, their operating margins are so low. Though taking a look at total gross margin at 68% is pretty great. It's just their net margin, so I'd be curious to see what some of the expenditures are. But let's take a look at revenue here, because their revenue has been very consistent and up to the right. It's one of the few companies where they've just continually seen great growth, with the exception of the pandemic, where obviously people weren't going out as much, and they were probably looking to save money with some concerns until that helicopter money baby came flying in on us. That probably led to some of this excelled growth. They typically trade within this, 14 to, higher single digit to lower teen digit growth rates, which has been very common across the entirety of the history of the company. But if we take a look, maybe we'll do some comparables on the net income side, because their net income has been a bit dodgy here as well, but has been actually going up as of recently, which means the stock could be trading at a discount, which means there's good earnings per share growth, right? I mean, earnings per share comes from that net income, which has actually been trading in the 20 percentile range. But keep in mind, earnings per shares are highly manipulated, especially with a company that's been buying back shares year over year pretty aggressively in some years. That always leads to higher earnings growth, because there's less earnings to compare against the shares outstanding of the company. But if we dive into the actual balance sheet itself, there's some things that I find super intriguing in here. Firstly, this company is operating an insane amount of stores. Their store count here, if you take a look, is at 17,931, up 3%. Even if you're growing store counts at 1%, when you're talking about almost 18,000 stores, you know how insane that is? Like, that's just jaw-dropping. So operating margin here, as mentioned, like, they're showing about a 21.4%. Operating income, very nice, up 25%. So they're doing some stuff to clean up the balance sheet, as many companies have been. A lot of companies have been focused on growth and profitability in this tougher market environment, because they know that's what's been benefiting shareholders and moving the needle. They've had some pretty reasonable revenue growth as well, as we've looked at. You can see that here, from $7 billion in 2021 for the quarter end to $7.7 billion. Very nice to see that 9.5% increase. But what I want to take a look at, and they also have obviously licensed stores too. I mean, they have company operated stores and licensed stores. But what I want to pay attention to is something that really sticks out to me in this kind of retail coffee based industry, is the fact that their total assets sit at about $29 billion, but their total liabilities, if we take a look here, is actually their long-term debt at $13 billion with a total liabilities of $37 billion is actually, they're operating at a deficit by almost $8 billion. And unlike real estate, where a healthy balance sheet for a real estate company is around 30 to 50% leverage, even infrastructure companies typically aren't this heavily leveraged. So I find that always very intriguing because everything else about Starbucks is absolutely astounding. It's just if the company had to liquidate everything today, they would be in a deficit of billions of dollars. Whereas you compare this to the likes of tech companies, of your Metas and your Googles of the world, those companies have like so much cash they could pay off pretty much all their liabilities and they'd be rich still, like with like $100 billion, a couple $100 billion of wealth, whereas Starbucks and these retail companies couldn't say the same. So I always find it very intriguing. But you got to keep in mind that these companies do own real estate as well. Like that seems to be the underlying value, especially with a company like McDonald's. So incomparable. Let's just zoom out real quick because McDonald's has been in a very similar trajectory. Both these companies trade in line almost. McDonald's up 177%. Very similar growth rates over the last decade. 2.5% starting dividend yield, very similar to where Starbucks currently sits, but much, much bigger market cap, almost $200 billion compared to the $100 billion, double the size basically of Starbucks. So let's just do some quick side-by-sides. Dividend, first and foremost, they got about an 8% growth rate over 5 years. And at the scale, it's understandable that it's a bit slower. But if we take a look at the history here over that same decade, they've gone from 81 cents to about $1.67. So doubling of the dividend. Again, very nice to see. What we'd want to expect is about, like I said, my favorite thing is to see a doubling of the stock in a decade and a doubling of the dividend. And both these companies have excelled beyond that. So you can't really complain, right? Because your yield on cost would, you'd be closer to a 5% yield or over, you'd be at about a 5% yield after a decade and you've seen well over doubling of your stock price. I mean, the returns here have just been absolutely stellar. So from a revenue standpoint, McDonald's has been all over the place. It's one of those companies where I could never really understand how over time their revenue was going down, yet the stock price was going up. But again, a lot of that could do with asset value increasing. There's so much going on here. But recently, McDonald's has done a fabulous job at turning this revenue around. And if we take a look again at kind of the net income here, net income has been exploding as of recently, leading to higher earnings per share growth, actually record earnings per share growth, and with shares outstanding coming down pretty dramatically here as well. So they're increasing their earnings per share. But I think a lot of this has to do with their margins. McDonald's is a company that is just crushing operating margins and gross margins. Like, whew, baby. I mean, we're talking tech-like margins here. And this is a company that I think is going to see a huge boost in the technological jump, the revolution that's happening. As somebody that worked at McDonald's for 2 damn years, I mean, their operating line could easily be, efficiently roboticized away. I mean, working there, you could have a robot flip the burger, put it on the bun, and then you just put some ketchup, some tomatoes, whatever, your pickles on it, call it a day. The fryer's into the fryer. Hell, they've already automated away so much with, I'm sure you go in and you're using the screen pad instead of using one of the actual clerks that work at the front desk. They've kind of cut their clerks in half. Those front desk operators are getting cut down. That's the direction they're going in. So I could see continued margin expansion with a company like this, which is why I think McDonald's is a pretty superior buying opportunity, because they're the cheap man's restaurant. It's the restaurant that a guy like me goes to when I'm out and about, and I don't want to spend a hefty premium on, a $5 coffee or an $8 coffee when I can get one for a couple bucks at McDonald's. You get your junior chicken, you're spending like $5. So for the same price as Starbucks, you get basically 2 for 1. I can see my dollar getting stretched a lot farther. And obviously, that's just kind of my demeanor. It might not be yours. There's nothing wrong with Starbucks. A lot of people do love it. So let's do a comparable when it comes to those assets, liabilities. This company with revenues growing at 8%. Again, high single digits here, not really that bad. This is a company that has reached scale. It's a dinosaur. It's been around for quite some time. But if we scroll down here, what I want to pay most attention to, again, incomparable, where are our assets? Right here. So if we take a look at their total assets sitting at $56 billion, we do a little bit of math against their liabilities with their total long-term debt sitting at $37 billion, other leasable liabilities, you add all this up, you're sitting at around $53 billion, I believe, in total liabilities, give or take a couple $1 billion, which again trades in line. I think they're slightly above their current debt to asset ratios. Again, much more favorable than Starbucks, but still, again, kind of crazy to me that these companies operate with such a heavy load of long-term debt, right? So it'd be neat to see, again, you'd have to dig into it to see what these leasing terms look like, because you can see their long-term leases in here and what those debt, those interest rates on those look like, but they can't be hindering them too much because they've been able to grow very nicely. And we can see their cash provided by operations is sitting at $9.6 billion, which could easily cover, a lot of their current, liabilities. I mean, there's not too much concern here. So McDonald's for me has always been a favorite. It's one that I followed for quite some time, and I've been trading in and out of it. Depending on what my RSP contribution room looks like for this year, I might actually considerably think about maybe re-adding McDonald's, because it is trading at a dip here, and every time it's dipped, it's always come back. But you could say the same about Starbucks. Honestly, I'd put both of these companies in the same category. They're not going anywhere anytime soon. I just feel as though McDonald's is probably a more recession proof oriented business. I don't feel like we're in a recession. I feel like people who love their Starbies are going to it still no matter what. I just always feel like in the worst of worst times, McDonald's is the favorable choice for a long-term, more stable oriented business. But that is just my humble opinion, and I'm not here to debate these two companies. I think they're both great. I just wanted to offer some favorable insight and pass the question off to you. If you were to buy one of these, what one would you buy? What one are you going to? I'd love to hear about it in that comment section below.